Hi, I'm Samuel from Traders Insight, and today is the first edition of Don't Do That Trade. I wanted to do a video yesterday where I was going to implement an iron condor on the nearest, actually on the monthly options chain that has 10 days left to collect theta quickly. Now, the reason that I wanted to do it is that Netflix, let's take a look. Netflix monthlies have 9 days left, which is when pretty much all of the theta decays, and it's a good short trade. So I have a Excel spreadsheet which I use to calculate the wings and the guts of the iron condor. Yesterday I did the calculation and it told me that as long as I sold as long as I sold a put credit spread at 590 and a call credit spread at 735, I would have a good chance of sticking where to the markets had priced in the options. Now, I went back afterwards, and as soon as I made the video, I knew that I had done something wrong because I had forgotten about the one thing which is always consistent with stocks. It happens 4 times a year, and that is earnings. Netflix earnings, if we take a look, is going to be on July 15th. That is in 1 week. 1 week from today, Netflix will have its earnings. So let's take a look at the trade page right now. We can see that there's already a big difference in implied volatility between the July monthlies and the August monthlies, almost a 20% difference. Now, what that means is that the market makers are starting to price in the earnings move. Now, as we get closer to earnings, there's more uncertainty in the market, but there's more unknowns about whether the stock is going to go up or down, and so the market makers price that in. Now, when I made let's get rid of this. We'll come back to this. Now, when I made the video yesterday, I immediately went back to the Think Back, which is a tab under the Analyze tab, and then Think Back to check what the implied volatility had been at the last earnings session. So looking back to April, which was the last time that we had earnings, on the day before earnings, implied volatility was at 156%. That's quite high, to say the least, especially compared to the next month. So if we let's take a look at just adding some more. If we look at the front month versus the back month, there's almost a 90% difference in volatility, or implied volatility. Now, when we get there, when we peak at implied volatility, that's a great time to trade. But if I had set up the iron condor now, I'd be exposing myself to Vega. And when I say having Vega exposure is essentially that the volatility increase would offset the theta decay. And I would actually end up paying more for the options because of the increase in volatility. And I can show you that right now. So if we go to the Analyze tab and we click on Add Simulated Trades, okay, if we come down, we can find Netflix, okay, and then we can add a simulated trade by finding the 590 strike here, right-clicking, Analyze Sell Trade, Iron Condor, and we can come down here. It'll be down here. We have the 590 and the 587 puts for the wings, and then we can add the 730. I believe it's 730. Yeah, then we can add the 735 calls to be sold. So these are the 737s for that, and the 735 that. So if we did this trade right now, we would be collecting 87 or 85 cents in credit, which we would hold to the end of expiration. But let's take a look in the risk profile, and I'm going to change this to the normal +1 at expiration. So based on what we have here, let me make sure the other one is clicked off. Okay. So based on what we have here, we can see that if we change this back to today, let's change it back to today. As of today, if we made this trade right now, we would be making about $1, or maybe losing $1. And if we click through the days, getting closer to expiration, you can see that the white line approaches the red line, which is expiration day. And as theta decays, we make our money. And that's how we make our money as option sellers. And here is expiration Friday next week. And as long as we were in this range from 590 to 730, we would collect the full credit at expiration. However, we know that this is just assuming that volatility is going to stay the same at 70%. So let's come back up here and we can click on this and we can go to vol step. And we're going to add in 4 vol steps. And yeah, okay. We're going to actually come back down. Okay. So I wanted to hold this trade until the day before earnings, which will be the 14th. So if we look at our current vol, or the average vol right now for the back months, it's around 50%. We would make around $500 if we held this to the 14th. However, because earnings is coming up, volatility is increasing. And when volatility increases, so does the price of options. So if you sell an option and then that option becomes more expensive, it becomes more expensive to buy it back. Okay, so right now we're at 70. So if we held this to 70, let me see if I can get it. So if we held this, we can see that, why isn't this going? Okay, we can see that 70, which is around where we're at right now, would net us around $200. But since we know that volatility is going to increase to around 150%, because that's what it did for the last earnings and the earnings before, we can see that we would actually be losing money, a lot of money, around $486. Now, the day afterwards, once volatility returned to normal, then we would collect that $582. But the point of holding the iron condor is to have the stock not move anywhere. And with earnings usually comes big stock movements. If we take a look at Netflix over the past several earnings cycles, we can see that there are always big gaps. So there's always the chance that even if we do set up an iron condor, that it could gap up immediately after earnings and when volatility is still high before it returns to normal, and we would be losing on the trade either way. So that is the bad trade that I talked about yesterday, and it's something that you need to be aware of. Earnings come around 4 times a year, and volatility always increases. I'm going to do another video on actually doing this same trade with iron condors in a few days once Netflix volatility increases and we can actually set up a trade to profit from it. Thank you guys for tuning in and watching this video. I will be back, and don't forget to come to our webinar on Friday. We'll see you then.